Good afternoon. I'm Emily Ackerman, the Director of Business Development here at Lane Gorman Trubit. I want to welcome you to our first webinar of 2023. Today's webinar is the first of our 8-part series this year. All of our webinars are now open for registration, and you can check out the full list on our events page at www.lgt-cpa.com/events. Today, we will be discussing an update on the Texas Legislative session. We are excited to be offering a diverse selection of webinars in 2023. And to tell those of you joining for the first time today, Lane Gorman Trubit is a mid-sized accounting firm for all businesses. And in 2023, LGT will be providing you endless opportunities for gaining CPE credit. These events are created to help your business grow and thrive and get continuing education. We cover a broad range of topics that are impactful to the business in the construction, M&D, dealer service, real estate, and not-for-profit industries this year, but we always want to make sure we are providing you with the topics that you need more information about. So please make sure to fill out the evaluation after the event and leave a comment with your suggestions. This webinar will be available as a recording within 2 business days following this event today. The link to our YouTube can be found on our resource page, social media, and in today's chat. If you have any questions about this or any array of our services, or would like to set up a free consultation to determine how we can help you and your company and organization, please send us an email at askus@lgt-cpa.com. All of these links will be included in the chat. This is a continuing professional education event, and you will receive 1 hour CPE credit upon completion of the class evaluation. Following the webinar, you will receive an email from ProLera, our CPA provider, to fill out a survey and receive a CPE credit certification. Please take the survey to gain access to the presentation material as well as your CPE certificate. Please submit any of your questions to the Q&A function at the lower part of your screen today. These will be answered during the presentation and live at the end of the webinar as well. With that out of the way, I am excited to introduce you guys to Jon Wellington, our state and local tax principal. I call him Mr. Salt. Jon Wellington is a licensed attorney that has spent over 20 years serving the public, specializing in matters unique to state and local taxation. Jon is the leader of the firm's SALT practice, drawing matters unique to state, drawing on expertise making with some of the largest accounting firms in the world. Jon's expertise in SALT matters include audit defense, income and franchise tax planning, sales and use consulting, nexus studies, and property tax minimization. Jon is exceptionally well-versed in all the state and local tax needs for clients in the construction, manufacturing, distribution, and not-for-profit sectors, as well as basically every industry, especially if you're doing sales in multiple states. Without further ado, Jon, you have the floor.
Well, thank you very much for that kind introduction. We're here to talk today about what's going on with the Texas Legislature, which is in session right now. In preparing the presentation, I think that it probably won't take the full amount of time to talk about that matter. So I've also included some discussion of what the trends are out there in the other states and their legislatures and the big topics that are being considered. Because ultimately, if your business is doing business across state lines, then you also need to at least be aware of what's going on with other states as well. Also did not realize when we scheduled this webinar for April 19th that literally tax filing day was the day before. Usually you think of April 15th, but actually this year it was yesterday. Monday was, the 15th fell on a weekend. Monday was a DC holiday, so it doesn't count towards, or counts as a holiday for these purposes. So I thought I would actually just start with some fun facts about taxes in general in the filing season, just so you might just have a feel for kind of big picture of what things look like, at a bird's eye view. So a couple fun facts, if you will, about tax filing season. Here's some statistics coming from the Tax Foundation, which is a nonprofit that, knows a lot about taxes. And the most recent information available is for the 2020 filing season. So for the 2020 tax year, 157.5 million tax returns were filed. reporting $12.5 trillion in adjusted gross income. From those returns, individuals paid $1.7 trillion in individual taxes, which was a $129 billion increase from 2019. The top 1% paid an average income tax rate of 26%, and the bottom half of taxpayers paid an average tax rate of 3.1%, excuse me. And all taxpayers together, the average income tax rate was 13.6%. Comparing 2020 to 2019, the top 1% income rose from 20.1% of all income to 22.2%. And it's also worth noting that the top 50% of taxpayers paid 97.7% of all federal individual taxes. So those are just some facts to kind of give you a feel for who is really paying all the taxes going to the government. The IRS recently issued a press release, as you may know, as a result of some recent legislation at the federal level. They hired a whole bunch of people, and the IRS was proud to say that their customer service is much improved. We as a firm can vouch for that. Their wait times on the phone for us have been much better. Per their press release, they answered 2 more phone calls live this year than last year. The average wait time for a phone call was cut down from 27 minutes to 4 minutes. And what they called their level of service for answering live calls went from 15% to 87%. So hopefully if you have to deal with the IRS, hopefully you'll have a much more pleasant experience, at least talking to them, maybe not so much, on the substance of whatever it is that you have to talk about them. So I thought that'd be some interesting stuff to keep in mind as we shift over to talk about our main focus for today. And so here's the agenda that I plan to talk about. Just kind of give a feel for where Texas stands financially going into the legislative session. The primary focus of the legislative session, as I'll talk about in greater detail, is really focused on property taxes. So that's where the bulk of this presentation will come from. And then I'll touch on those other Texas bills. And like I mentioned, talk about some state trends that are out there. And if you have any questions throughout the presentation, please feel free to type them in the chat, I suppose, and Emily will let me know about them. Otherwise, we'll have some time at the end for some Q&A. All right. We are dealing and talking about the 88th Texas Legislature. As you may or may not know, the Texas Legislature meets on a biannual basis, so every 2 years as opposed to every year. Going into this year, the expected budget was about $288.7 billion. Last summer, the comptroller had estimated that Texas would have a $27 billion surplus. In the 6 months since then, it turns out that the actual surplus turned out to be $32.7 billion. So it was much higher and grew very quickly compared to the expectations. What was the cause for this unexpected surplus? A lot of it had to do with increased sales tax revenue. We all know that inflation has been a real issue, and while that is not a good thing for people who have to pay it, naturally, if you're paying higher prices, then you're paying higher sales tax to go with that, and that led to increased revenue for the state. Similarly, on the severance tax side, which is a significant portion of Texas's budget, higher fuel prices, primarily due to the war in Ukraine, led to higher severance tax revenues than expected. So hopefully both those things are not things that will continue to occur for too much longer. So the goal or the expectation going in was people looking to spend this money, sure, but not on things that would lead to much larger budgets and expenses down the road. Give you a feeling for how much $32.7 billion is as a surplus, it's actually higher than the entire state budget for 24 states. So we have, obviously, Texas is a very large state. To give you a feel, I looked, so that budget of 288, let's call that 150 for each year. California's budget's about 500 billion. So Texas is huge, but California even more so, at least with respect to their budgets. And of course, population. The way that Texas, there's legislation out there, there's laws about how much they can actually spend of a surplus that's tied to the actual economic growth, so that ultimately that entire $32.7 billion won't be spent, but nonetheless, that's kind of the number you've probably heard in the newspapers and legislatures talking about what they have to work with. And all those amounts don't include the amount of money that Texas has in what is commonly known as the Rainy Day Fund, technically called the ESF, the Economic Stabilization Fund. So this was a fund that was created in Texas about 25 years ago, basically due to the volatility in the oil and gas industry. Sometimes severance taxes are much higher than expected, and of course, sometimes they are lower. So Texas created this Rainy Day Fund that currently stands at about $13 billion. To give you a feel for how much that is in context, since 1988, the entire fund has spent about $17.4 billion on various projects, some water projects, some disaster relief, and some other various items. And that amount is expected to grow over the next few years. And the comptroller expects that the Rainy Day Fund should be as high as $27 billion in a couple more years here. At which point it'll basically be capped and can't grow anymore because, again, there's sort of a mathematical formula for how much can be in that Rainy Day Fund. So big picture, things look very rosy for the Texas economy and for budgets. And so legislatures are naturally eager to spend a lot of that money. And the biggest topic going into the legislative session was property tax. Governor Abbott had pledged to spend approximately, half of the surplus on property tax relief, with the intent for most of that relief to go to individuals. As we'll talk about more, that'll primarily be done through the homestead exemption. Also, the governor was focused on paying down certain school taxes, i.e. lowering the tax rates, and also reinvigorating what I'll talk about more, some incentives to lure businesses to come to Texas. So that was the situation going into the session. As we stand here today, there's basically two competing proposals on what will be the ultimate property tax relief legislation. I'll talk about both of them. Primarily, there's a Senate bill version and then there's a House version. Excuse me. So on the Senate side, Senate property tax relief is built into three separate property tax bills known as Senate Bill 3, 4, and 5. And those three together, when you add them up, the estimate is about $16.5 billion in property tax savings. So that's right about that 50% of the surplus mentioned previously. Senate Bill 3 is the big one. What that does is increases the homestead exemption. What is the homestead exemption? Basically, it's an amount of value of your home, of your primary residence, that is not taxable. So if you live in a $300,000 home and there is a $40,000 homestead exemption, which is where it stands today, then the most value of the home that could be taxed would be $260,000. So as I just said, the homestead exemption today is $40,000. That's a fairly new number that was increased recently from $25,000, which back in 2015, it went up to $25,000 from $15,000. So as you can see, this number has grown, pretty quickly, pretty fast. And so the proposal under Senate Bill 3 is to raise that homestead exemption from $40,000 up to $70,000. And then for the elderly and disabled, that exemption will be $100,000. Just to give you a feeling for kind of what that translates into tax savings, that alone they estimate about $664 in savings on a $300,000 house. So, about $220 in savings per, $100,000 of value. So that's Senate Bill 3. It's not very complicated, but obviously that's a significant amount of dollars that are kind of built into just raising the homestead exemption. But there's two other pieces to the Senate proposal. There's also Senate Bill 4, which reduces the number of schools districts affected by recapture, which is essentially, this is not going to be a class on how school finance works in Texas, because I certainly won't do the best job of explaining that. But essentially, there's what people refer to as Robin Hood, where to the extent that property tax is paid in a wealthy appraisal district or kind of exceed certain amounts based on students and various things related to the schools, that money is then distributed to other school districts, and that's known as Robin Hood. Basically what Senate Bill 4 does is, it's hard to kind of talk about specifically, but ultimately it leads to a reduction in school district tax rates, which would further increase the savings mentioned above, just from Senate Bill 3. So that's all primarily, straightforward. Senate Bill 5 might be kind of the most interest to folks here, at least as it relates to their businesses, as opposed to their, just being individual residents of Texas. So Senate Bill 5 reduces business property taxes. Really should just say taxes overall, as I'll explain, by about $1.5 billion. So how is that achieved? By basically two things. Primarily, they're going to raise the business personal property tax exemption from $2,500 to $25,000. So what is that? So in Texas, Texas taxes both real property and what they call business personal property. And taxpayers file a rendition form each year, due April 30th, I believe, coming up here. So you declare to the local district all your property, your tangible property, and they assess tax on that amount. And historically, you got an exemption for some of that business personal property. A while back ago, that amount was only $500. It was recently raised to $2,500. And now Senate Bill 5 would raise that amount to $25,000. And I'm going to just speak a little bit more about the details of that amount, because ultimately what they want is that to apply to each location. They don't want taxpayers to kind of put, $25,000 of property into 4 different entities and pay zero tax, as opposed to if one entity had $100,000 of property and only got that $125,000 exemption. Along with that, Senate Bill 5 also proposes a franchise tax credit that would equal 20% of the tax paid on a business's inventory. As I mentioned, taxes, not every state taxes inventory, but Texas certainly does. And so if you are in fact paying inventory tax, then this bill would suggest that you would get a credit on your franchise tax bill. And that amount is capped at $1.5 billion for the 2 years. So basically for there'd be about $525 million available to go towards that franchise tax credit. And if this were to pass, it would essentially be effective, not for taxes due on property owned at 1/1/23, but it would be effective for immediately for next year. So just to clarify a little bit on that piece about the inventory and the $25,000 exemption, basically it says if you got related business entity that's part of a unified business enterprise, then they're going to kind of smush you all together and treat you as one taxpayer for purposes of this exemption. And here's just some of the language from the statute that basically gives some definition to those terms. But it's kind of, the intent is pretty clear. Again, not have taxpayers kind of manipulate the system to get a $25,000 exemption multiple times just by having their property in separate legal entities with separate property tax accounts with the appraisal district. So that's the Senate side of things, that we give about $16.5 billion of property tax relief. The House has a different alternative approach. And that House Bill 2 just passed about 10 days ago. What that would do is primarily a couple things. It would reduce the maximum school district tax rate, and it would lower the appraisal cap. What the appraisal cap is Texas only allows the value of a home to increase by 10% in a year. So there's a cap on how fast the value can rise. So House Bill 2 would lower that 10% cap to 5%. And when you combine the reduction in the school rate with that slowing down of the appraisals, they expect to actually save taxpayers about $500 million more than the Senate proposal, i.e. about $17 billion. And their estimate is about $1,000 in savings on a $350,000 house. So with respect to House Bill 2 and its focus on an appraisal cap, Lieutenant Governor Patrick has spoken out against the House bill version. There's a well-known taxpayer advocate group known as TARA, the Texas Taxpayers and Research Association. They're very harsh towards appraisal caps. as they put it, it's false relief. If you think about it, or, per them, if you think about it, essentially, if you cap the increase on those homes, then you're really forcing higher rates on everybody else and on any other types of property that are not residences. Rental property, if you buy a new home, then that cap's not going to help you because you're going to owe tax if they know your sales price. And that cap is not applicable to business property. So ultimately, if you limit an appraisal district's ability to raise the value of the homes or the property that they're assessing tax on, all they're going to do is just raise their rates. And so again, sure, you could put a cap on homeowners' value, but that just means that everybody else's property taxes go up faster. So those are kind of the arguments against the appraisal cap type of approach. So those are really the two big competing bills. We don't know exactly how this will fall out. I think that the governor and other folks, a lot of them are on the side of the Senate bill. So we'll just have to see how that turns out. We'll probably have some resolution to that in a couple of weeks here. And I'll talk about the calendar in just a couple minutes here. So when we think about property taxes and you think about Texas, Texas is pretty well known or takes pride in being a low tax rate state. Obviously, there's no personal income tax here. But when it comes to businesses, Texas is not quite as tax friendly as you may think. Here are some statistics to support that. In 2021, Texas businesses paid almost 60% of the taxes paid to Texas. In most states, that percentage is typically about 43.5%. So that is the 5th highest percent of taxes paid by businesses here in Texas. And when you look at the really big states, that's the highest by far. Another way to look at things is ultimately how much is the effective tax rate on businesses. In Texas, it's 5.4%. with a national average of 4.9%. And with the tax on, with the relatively high tax rates in Texas, on industrial property, that usually turns out to be about an effective rate of 2.27%, which again is amongst the highest in the country. A lot of states don't tax inventory in the first place, but Texas does. So that's yet another way in which Texas is not business friendly in the property tax code, at least. So that's part of the reason why there's a big emphasis on property taxes. But a lot of the things we mentioned, obviously the homestead and appraisal cap, those things all relate to residential property and don't really do a heck of a lot to improve the property tax posture for businesses. So Texas does have other tools in their, at their disposal. Historically, I'm sure you know that there's lots of states that offer incentives to businesses to come to their state. Hey, come invest in our state. We'll build this for you. We'll take away these taxes for you, etc. And so Texas historically has done that in a couple different ways. And the two biggest ones, at least in terms of property tax, are kind of known by the chapter in the tax code where they're located. So there's tax abatement agreements, chapter 313, and there's what's called value limitation agreements, which are called chapter 313. Tax abatement agreements are probably the ones that kind of make sense to most people and are kind of straightforward and are relatively easy to understand. Taxpayer says, hey, I'm going to spend $100 million in your state, and you're going to say, hey, I'm not going to tax, I'm going to give you a lower tax rate on that property, and and that's how it works. We're abating your taxes. So those are available to taxpayers to enter into between themselves and taxing jurisdictions, except for school districts. So school districts do not enter into tax abatement agreements. There's various reasons, political and otherwise, for that, but nonetheless, we're not really here to talk about chapter 312, but what's more interesting or relevant to the legislature is chapter 313, these value limitation agreements. And those are the types of agreements that a taxpayer could enter into with the school district. So the way a chapter 313 agreement works is the taxpayer says, hey, I'm going to invest a certain amount in your appraisal district or your school district and create a certain amount of jobs. In exchange, for 10 years, you will limit the value that you assess that property at. So if I invest $100 million, you may come to an agreement, and a lot of this is set by law, or used to be, as I'll say, then you'll only be taxed on the value of $50 million for 10 years or whatever the case may be. And in doing so, and what those amounts are is, this thing has been, Chapter 313 ended last year, to spoil my next slide. So, so a lot of this is not around anymore, but the way it used to work is, depending on the amount of industrial property in a district and kind of how rural that area is, its population, the amount you needed to invest and the amount that they would say will limit the value of your property at would vary. The more rural the place, then the lower the threshold to invest and the lower the taxable value on that property. So these Chapter 313 agreements were very political, involved a lot of negotiations with school districts. They were limited to only certain kinds of taxpayers. It was limited to manufacturing, R&D, clean energy, and some data centers. And historically, it's the wind farms of the world that were primarily getting advantage of Chapter 313. They would build set up a bunch of turbines in West Texas or wherever, and ultimately they would end up not really needing many employees to, it basically just sits there, right, and spins the turbine. So not a lot of employment was really generated. So there was a lot of critics of the program that said, hey, it's basically corporate welfare. About $1 billion in tax breaks were given out. And again, when we talk about Robin Hood, these things, these 313 agreements were outside of kind of the school finance world. So companies would enter into what's known as a pilot with the school district. Pilot stands for payment in lieu of tax. So over the years, they'd taken some steps to limit these, but what would happen is the company would say, all right, I'm saving $50 million in property tax with you, but I'll go ahead and I'll pay you, the school district, $10 million, and I'm still making out well. And then that school district would basically get to keep that money, and that money would not be built into the calculation of Robin Hood, so that, there's very little downside for the school district to enter into these agreements, even if they weren't great deals, because, at the end of the day, they're making incrementally more money no matter what. So 313 had its, its advocates and its opponents, and it used to basically the provisions would sunset. So many times, the legislature said, hey, we're not going to continue this thing, but they did. And then ultimately, last go around in 2021, they declined to consider a bill to extend the program. So Chapter 313 ended at the end of last year. And I think they showed that so there's this big flurry of taxpayers trying to get these agreements at the end of the year. And I think about 70% of them were wind farms, which kind of, again, goes to the point that these were primarily being used by these renewable projects. So without Chapter 313, Texas lost, agree or disagree, nonetheless, they lost arguably a valuable tool to bring businesses into Texas. Governor Abbott specifically blamed the lack of Chapter 313 for Micron making a big investment in New York instead of in Texas. So he is motivated to bring back Chapter 313. Lieutenant Governor Patrick kind of disagreed that, with that approach, and feels like any replacement should be something very different. Ultimately, what has happened in the legislature is House Bill 5, was proposed to replace Chapter 313. And that would limit the eligible projects to a bunch of different things. You could see here, supply chain facilities, oil or aluminum refineries, various kinds of manufacturing, a grid reliability project. But what you won't read in there is renewable energy projects. So, this is the proposal, one way to handle the overabundance of agreements being with the renewables, is just to exclude them. Unlike the old Chapter 313 that would sunset every so often, this would be a permanent addition to the law. And the way it's written is essentially the comptroller would have ultimate say of yes or no of whether these projects went forward. So again, we'll wait and see if this gets approved. But this is essentially not something a lot of people know a lot about, but nonetheless is a big deal for the government, or the state government, and trying to entice businesses to come to Texas. So that's really where things stand with respect to property tax. Those are the, there's the two big competing bills, and then there's this proposed Chapter 313 replacement. And so because obviously huge dollars at stake, that's kind of sucked up a lot of the oxygen when it comes to tax bills in the legislature. So I'm going to continue to talk about some of the other bills that are going on, but this is really the heart of what's coming out of the legislature. But I know everyone needs CPE, so I got to talk for about 20 more minutes. So we're going to talk about some other bills as well. And again, some other state activity that might be of interest. On the sales tax side, every year, there's all sorts of, tons of bills are introduced and proposed, exempt this, make the tax go away, that sort of thing. So I'll just highlight some of the bigger ones that have some reasonable chance of success. Senate Bill 1000 would cut the sales tax rate by 0.5%. Usually, again, these kind of go nowhere, but nonetheless, this one seems to have some support. It would be very expensive, be about a $7 billion revenue loss. But nonetheless, there is some support out there for this one, and there is a chance this one passes. Texas tax rate, the state level is 6.25%. You figure 2%, for most local areas, so 8.25% gets you to one of the highest rates in the country. So usually I would just dismiss this one out of hand, but this one actually has a chance of passing. Again, I highlighted a couple other bills, exempt diapers, baby wipes, bottles, maternity clothing, and other related items was one bill. There's another bill trying to exempt sales of firearms, their accessories, and ammunition from sales tax. And there's another one that would increase the vendor's discount from 0.5% to 1.5%. I don't know if you're all aware, but when you file a sales tax return, you basically get a 0.5% refund, rebate, whatever you want to call it. That's kind of their way of saying, we know you've gone through this administrative hassle, and your reward is this 0.5% of your taxes you get to keep. So obviously that to increase that to 1.5%, would triple that amount, and would basically just be putting dollars back into taxpayers' hands. Something that's a real big area of interest for the government, for the state and local government, doesn't really affect, it affects people, and we've had clients get audited by auditors who are focused a lot more on this local tax sourcing issue. I won't get into all the detail, but historically, Texas says, hey, if you're selling something, if you're located in location X and you ship it to customer Y, or customer in location Y, Texas says wherever you, the retailer are, that's where you source your local taxes. So you would pay local taxes based on where the retailer is, and that's known as origination sourcing. Other states, or for other reasons, other people would say, no, it makes sense to collect the local tax based on where the customer is, known as destination sourcing. So a couple of years ago, and all these rules are in a comptroller rule known as Rule 3.334. And really the issue came around with online purchases. So let's say somebody is purchasing something online. They don't deal with the retailer location. They just go to a website and make a purchase, and that stuff is shipped to the buyer. The comptroller is saying, hey, in that case, then local taxes due based on the buyer's location instead of the seller's location. So that is the total opposite of what retailers were historically used to. And so the real issue there isn't so much that, if it's 8.25, it's 8.25, right? You're not too worried as the retailer about the amount of the tax, but it really impacts the localities that are supposed to receive the tax. And so picture, for example, Round Rock, where Dell has a bunch of warehouses and other locations, but not customer-facing locations. And Round Rock entered a variety of deals with Dell saying, hey, you build this stuff here, you're going to increase the sales tax revenue to the locality, so therefore we're going to give you all these perks and special treatment. Well, all of a sudden, if you say, hey, all those taxes that we're expecting to come to Round Rock because that's where Dell is, now you're going to source those taxes to where their customers are. That is a huge impact on their local revenues and their budgets, of course. And so a bunch of localities led by Round Rock, have filed suit against these change in the law, or at least what they perceive as a change in the law from the comptroller. So the comptroller, as I mentioned, that's a rule, which is, you even know as a regulation. Comptroller can't go against or create its own law. All he can do is interpret the law. And so the rules are supposed to be an interpretation of the law, but these are, in these lawsuits, they're arguing, hey, you're not interpreting the law, you're changing it, right? You're changing it from origination to destination sourcing. So as I mentioned, that happened a couple of years ago, this change in the rule. With the litigation, the comptroller put the rule on hold, and then they've kind of proposed the rule, which is still out there. But nonetheless, everyone is hoping that there might be a legislative solution to this and therefore kind of remove all this ambiguity in these lawsuits from the matter. So there's a few bills out there. It doesn't really matter how many there are, but a bunch of them are basically saying a bunch of different ways, hey, if this item is shipped from somewhere, then that's where that tax should be sourced to, where it's shipped from. But nonetheless, there is also a House bill out there that would source that sale to destination sourcing, and all sales would be sourced to destination sourcing, which would again be the total opposite of how things stand today for retailers. So we'll have to wait and see where that lands. Again, it may not impact so much the dollars, but if you have an auditor knock on your door now, they make a special focus of figuring out, do we need to reallocate your local taxes? And they may say you need to refile or amend some returns to reflect that. So that's pretty much it on the sales tax side. Turning to franchise tax, as I mentioned, as part of the property tax bill, Senate Bill 5, they would proposed a new franchise tax credit for property tax paid on inventory. That credit would not apply to motor vehicle inventory. That would be specifically excluded. There's a variety of reasons for that, but probably a lot of it has to do with motor vehicle inventory. You don't kind of pay property tax in the traditional sense. You pay what's known as a vehicle inventory tax, which is computed differently. There's a bunch of other proposals out there for various franchise tax credits, whether it's for hiring a qualifying apprentice for a vocation, for offering to subsidize childcare to employees, or to offer worker training and programs to your employees. We'll just have to see if any of those pass. House Bill 3706, I don't know if any of you ever get notices from the state, but if you've basically failed to file a franchise tax report, usually they just slap a certain number on there and say, hey, here's your estimated assessment we'd like you to pay. And so this bill would remove that estimated assessment. If the only thing the taxpayer did wrong was not file the return, they would just say, hey, you need to file a return without offering an estimated assessment. And there's also a bill out there, as it stands today, if you have $1 million or less in total revenue in Texas, then you don't owe any tax. And there's a proposal to double that threshold to $2 million. So what comes next? The legislative session, all the bills have been introduced. There's going to be no more bills than anything that we just spoke about. Right now, what's going on are committee meetings and hearings with the public, people presenting different arguments. Ultimately, all of that will be resolved and everything will be voted on no later than May 29th, at which point the governor must either sign the bill or within 10 days or veto it. Otherwise, it becomes law within 10 days. So that's everything I had to say on the Texas Legislature. I'll just pause there for a minute and see if there was any questions or any other comments before I kind of talk about some other state trends. All right.
Don't be shy, guys. You can do questions.
I'll take that radio silence as a no.
We want more states.
So let's just talk about other states we got about another 10, 15 minutes. Big picture. Most states have focused on cutting tax rates as opposed to raising them for a variety of reasons we talked about. In Texas, a lot of that holds true with other states in terms of inflation, raising sales tax revenues. A lot of states got a lot of funds from the federal government around COVID time. So the fiscal health in most states is looking good. Certainly when it comes to the ability to offer tax rate cuts. So in fact, again, 21 states have cut tax rates last year or the year before. Another 12 are considering further tax rates here in 2023. But of course, there's still a handful of states out there that are looking to raise revenue by doing a variety of different things, usually involving high net worth individuals, whether it's to raise the tax rates at those highest levels or actually introduce some form of a wealth tax on such folks. The big issue in the sales tax world is, as it usually is, relates to technology and keeping up with technology and taxing services that are kind of new to the states and they don't really fully understand. One of the big areas, of course, is these streaming services. So historically, states would collect a lot of revenue from cable companies by imposing these franchise tax fees on them for their right of way to, all the wires and all the various equipment and plumbing necessary to provide cable. Involved a lot of, actual physical, it takes up space, it takes up land, and they have to, essentially the states would raise revenue and the localities as well by giving them the right to put their equipment and put all their wiring under the ground or above the ground, as the case may be. But as you may know, cable companies are kind of in decline these days. And so therefore these franchise tax fee, not franchise tax, but these franchise tax, these fees, these localities are getting much less revenue from that, and the states as well. And now they want, they'd like to get that revenue back. And a lot of these streamers are still using fiber optic cables to distribute their services. And so there's a lot of lawsuits out there trying to get them to pay those taxes, these franchise tax fees. Last August in Texas, Austin and 23 other cities filed suit on these franchise tax fees. And so while, again, it probably doesn't affect anyone directly on this call, it's something that's a big issue out there. Texas is not excluded from that. Bigger picture, when it comes to the actual streaming services, states essentially, most of them now, about 2/3 of them now tax streaming services as a taxable service, just like they would the sale of a CD-ROM or a DVD or anything like that. Some states still draw a distinction between streaming shows and streaming video games. And anytime you're dealing with technology, there's all sorts of, compliance, nitty-gritty type questions. Where should it be taxed? Should it be where the person is watching it, where they're billed? What if 3 different people are on the same account and they're in 3 different states, all that sort of stuff. So there's always complications in trying to figure out who gets to collect that tax. And that's something that's, recurring with the legislatures trying to deal with that. On a similar note, Maryland kind of was the first to issue this suggestion that digital advertising should be taxable. And so again, that raises a whole host of issues related to whether, historically advertising is not a taxable service anywhere, but nonetheless, if they see the chance to raise the revenue, then they think about taxing it. So a lot of states are focusing on this issue about digital advertising. And again, what is it? How do we tax it? Where do we tax it? All that sort of stuff. Similarly, states are trying to figure out software as a service. I mean, in its name, you hear software and you hear service. Well, historically, software is taxable and the service is not taxable. So what the heck is this thing where you have both words in the same type of product? So it gets very complicated. Again, I need to repeat myself, but technology always leads to these complications. What Texas has done is they treat software as a service as a data processing service. And it's a little bit quirky, but in Texas, they do tax data processing services, but they give a 20% exemption. So if you were to buy a piece of software and download it onto your computer, you would pay tax on 100% of that software purchase. But if you used, so if you downloaded Microsoft Word, you would pay tax on 100% of your purchase price. If you use Microsoft 365, I believe it's called, where, that it's in the cloud, then you would only pay on 80% of that amount. So basically same effect to the customer, but yet there's kind of a tax consequence to how you receive that product.
Hey, John, we have a question from Mark in the chat,
yes.
Which says, could you please comment on the issues around the R&D tax credit?
I think I need to pass on that one. I am not 100% sure. I know there's a lot of issues at the federal level, and I know for Texas franchise tax purposes, a lot of audits or reviews of or granting of those credits have been put on hold until they can sort out certain things. But I'm frankly not too comfortable trying to just answer that off the cuff. But I could try to do better. If you want to shoot an email or talk offline, I could perhaps give a better answer for that one. So sorry, but that's not so easy for me to do offhand. So again, states again looking for revenue. They're thinking about taxing tech companies that collect customer data. You know, the Facebooks of the world and Twitter and that sort of thing. Various ways that they could possibly do that. NFTs, it's unclear how states will handle that. Cryptocurrency, there's really not much that the states have said, but you know, it's basically treated as non-taxable intangible property, just like any other form of currency. So I think the last item I would talk about is what's known as, the SALT deduction. So real quick way of background, when the Tax Cuts Jobs Act passed in 2017, you know, historically, you got a deduction on your federal tax return for all the state and local taxes that you paid. Following that act, it put a cap on that deduction at $10,000. So if you were, if you pay state and local taxes above $10,000, you essentially do not get the benefit of that deduction for federal purposes. So that has a real immediate negative impact on taxpayers who live in a high tax state. You know, you can think of the Californias and New Yorks of the world. You know, if you're paying higher taxes, that used to give you some relief on your federal return, but essentially no more. So you might think that doesn't really apply to us here sitting here in Texas, but if you have any investments, if you have any business in other states that in fact are generating income in other states, then this very much does apply to you. So just even a Texas resident could have income from other states, and therefore that makes this issue, again, very important. So a lot of states tried to work around this, right? Because this was harmful to their residents. Long story short, they ultimately came up with this idea known as a pass-through entity tax, where they would say, hey, you know, if a partnership earns a bunch of money, right? Historically, the partnership does not pay taxes. All that income flows through on a K-1 to its partners, and those partners then treat that income as theirs. So what these pass-through entity taxes say is we'll let that entity pay the tax at the entity level. It doesn't count as a payment coming from the individual, and therefore, you basically don't lose the benefit of those taxes being paid. You'd ultimately have a smaller K-1 because the taxes, you know, were deducted from income. So you might get less money from the partnership, but you've already had those taxes paid on that, and you would get a credit on your state tax return for those credits that were paid by the entity. So for state purposes, you'd essentially come out the same, but you would not lose that deduction at the federal level. I know I'm going kind of quick and it's a little bit complicated, but here's an example that would kind of explain what I'm talking about, where essentially, you know, just as an example, $1 million of income, I just kind of go through this super fast. Essentially, you know, if typically you would pay those taxes directly as an individual on that $1 million of a California investment or business. But if you had the entity pay it, then in that case, on $1 million, you could save about $37,000, assuming that was about the personal tax rate of 37% at the federal level. So ultimately, in theory, it's supposed to basically be a wash for you at the state level, and it kind of removes the negative effect of this SALT cap deduction for federal purposes. But all of that is a lot easier said than done, and things get real complicated real fast. You know, historically, if you pay taxes to another state, then you get a credit for those taxes paid for your home state. So picture a New Jersey resident instead of a Texas resident, where a New Jersey resident has an investment outside the state. and then if the New Jersey resident paid taxes to another state, then they would get credit on their New Jersey taxes for that, those taxes paid. But what if the entity paid that tax instead? Would that New Jersey resident get a credit for those taxes paid, since, you know, it's not coming out of his pocket, it came out of the business's pocket? And again, those are issues that have kind of come up over time in trying to deal with all the various approaches that the states take. And yet another complication is the SALT cap limitation, and basically most of the provisions of the Tax Cuts Jobs Act expire after 2025. So now it's, you know, it's hard to believe that's only, you know, 3 tax years away. So how much, you know, how do we fix those problems? You know, what will come of those provisions? Will they be renewed? Will they be canceled? And then what impact would that have on all these various things that the states have done in reaction to the SALT cap deduction? The last thing I want to touch on is what's happened with all the telecommuting going on in the world. Obviously, COVID gave rise to a lot of different people working remotely, and certainly people work remotely anyway. As a general matter of law, you know, states say your wages are taxable where you perform your services, and that makes perfect sense. So, but a few states say, hey, if you're working in another state and you're only doing that for specifically New York has this convenience of the employer rule that says, even if you're working outside of New York, if you're assigned to a New York office, then we're going to treat all your wages as taxable in New York, even if you're not sitting in New York when you're performing the work. The only exception to that rule will be if you were working elsewhere out of state, but actually at an actual office location, not just from your home or something similar. So right now it's a big fight between New York, New Jersey, Connecticut, the whole tri-state area, arguing about exactly how this should work, and, you know, states kind of retaliating against the other state. And so, you know, a lot of states are trying to figure this out through legislative means, and some of them are working to, you know, preserve their revenue, and other ones are trying to make sure that other states don't get their revenue. So there's a lot of different ways in which this could be handled between the states and, you know, internally in a state. But the moral of the story is if people are working in a different location than their office, you know, a different state, you know, they could be arguments. Both states could say, hey, we both think that your income is taxable in our state, and you have to figure out exactly how to deal with that. So New Jersey, for example, is considering giving credit to their residents to file legal action against New York, saying you can't do this to us. So there's all sorts of different ways this could be handled, but, you know, it's definitely not an issue that's going to go away. It's only an issue that's going to grow. Again, Texas is a little bit different because we have no personal income tax, but nonetheless, same story. If you have folks sitting in another state, they may have these issues to deal with themselves. I feel like I went real fast there at the end, but that is everything I had to say. So,
And there really is no crystal ball, is there? It's just, you're going to have to monitor and follow all these stuff 24/7, really. It's
yeah, I mean,
always changing.
Yeah, I mean, the Texas stuff that I talked about will have some clarity in, you know, 2-3 weeks, exactly what the legislature will ultimately do with respect to property tax, if they'll pass any of these sales tax or franchise tax rule bills. But yeah, if you're dealing with multi-state issues, you always got to stay on your toes, or always feel free to reach out to a trusted advisor such as LGT, and hopefully we can help answer any questions you may have, or, you know, at least let you know what the potential concerns are, and just see where the chips fall due to various legislatures and court cases and everything else going on out there.
Never a dull moment. And your contact information is on our website, and the webinar today is going to be recorded as well. So if people want to rewatch this again and again, you certainly can.